In America today, even if you have money, you still can't buy home insurance. Home insurance in the U.S., a silent crisis in the South, and its far-reaching financial consequences. As climate change becomes increasingly evident and extreme weather events grow in both frequency and severity, the U.S. home insurance sector, particularly in the South, where hurricanes, wildfires, and tornadoes are common, is facing a deep, silent crisis. Residents in states like Florida, Texas, Louisiana, and California are dealing with skyrocketing insurance premiums, or worse, finding it impossible to obtain valid coverage. This insurance crisis is not only affecting the daily lives of individuals, but also having a domino effect on the real estate market and the broader financial system. For decades, home insurance has been an essential part of property ownership. It not only protects physical assets, but is also a fundamental requirement for obtaining a mortgage, crucial to the American dream. However, as climate-related disasters become more frequent and unpredictable, insurance companies are facing mounting losses. In 2022 alone, the U.S. experienced over 18 natural disasters with damages exceeding $1 billion each, totaling over $165 billion in climate-related losses. These staggering figures have forced insurers to rethink their business models, leading to sharp premium increases or complete withdrawal from high-risk areas. In Florida, home insurance premiums have risen by more than 40% on average in just 1 year. Some homeowners report paying $10,000 to $20,000 annually to maintain coverage, an unsustainable cost for middle-class and lower-income families. Major insurers such as State Farm, Allstate, and Farmers Insurance have exited high-risk regions, leaving behind smaller companies or state-run programs like Citizens Property Insurance Corporation, which are already overwhelmed. The lack of competition leads to poorer service quality and less reliable claims payouts. Without insurance, homeowners cannot obtain mortgages, as lenders require proof of adequate property coverage. This has slowed the housing market, particularly in coastal areas once popular for retirees and second home buyers. As the cost of homeownership rises and buyers retreat, property values are declining. In parts of Louisiana and the Gulf Coast, home prices have dropped by 10% to 20% in just 2 years. A troubling paradox has emerged. As insurance costs rise, property values fall, leaving many homeowners underwater, owing more on their mortgages than their homes are worth. The consequences go beyond individual property owners. Financial institutions, especially banks and investment firms holding mortgage-backed securities, are increasingly concerned about systemic risk. As collateral values drop and more borrowers default, the market could face a wave of foreclosures reminiscent of the 2008 financial crisis. But this time, the catalyst is environmental and climate-driven, not subprime lending. Some analysts have begun referring to this as climate financial contagion, where the impact of climate change spread into financial markets via the interconnected web of insurance, credit, and asset valuation. Local and state governments are also feeling the strain. As real estate markets slow, property tax revenue declines. Meanwhile, expenses related to disaster response and resilient infrastructure soar, from reinforcing levees to assisting with post-disaster housing. Inequality is growing as well. The wealthy can afford to relocate to safer areas, pay higher premiums, or self-insure. In contrast, lower-income families are often stuck in vulnerable zones, unable to sell, unable to buy insurance, and increasingly exposed to climate risks. Several solutions have been proposed, such as expanding federal insurance programs, e.g., the National Flood Insurance Program, offering incentives for insurers to return to high-risk markets, and investing in climate-resilient infrastructure. However, these efforts are hindered by legal barriers, budget constraints, and political divisions. Another challenge is that climate risk is still not fully integrated into financial modeling, from mortgage lending to real estate investment decisions. Until that changes, financial systems will continue to operate under outdated assumptions of stability, despite mounting evidence to the contrary. In the near future, the home insurance crisis in the southern U.S. will not resolve on its own. On the contrary, it may expand into other regions such as the Pacific Northwest or the Midwest, where floods, heat waves, and wildfires are becoming more frequent. As extreme weather becomes a new normal, the entire insurance and financial system of the United States will need to be reimagined to meet this changing reality. It will require coordination between governments, insurers, financial institutions, and communities, not only to protect physical property, but also to maintain trust in long-term economic stability. Ultimately, the most important lesson from this home insurance crisis is not just about money or contracts. It is a wake-up call. We can no longer ignore the real-world impacts of climate change. When these consequences begin to touch every home, every family, every mortgage, and every loan, it is no longer a distant threat. It is a present crisis demanding urgent action. Have you or someone you know been affected by rising insurance costs or home value drops? Share your story in the comments and subscribe to stay updated as we uncover more on this growing issue.